The crypto market of 2025 is volatile again. Bitcoin has stabilized after the halving shock. Liquidity is shifting. AI-linked tokens are the new speculative frontier, and every project that combines intelligence with decentralization is under a microscope. In that noise, one chart remains quietly deliberate: the blue and gold curve of Aifeex's AFX. Sitting today at $0.1173, it carries neither the hype of new listings nor the fear of collapse. It carries something rarer: momentum built on architecture. When AFX announced its AI-DeFi DApp launch on September 1st, 2025, few realized they were watching a system replace its own backbone. The move eliminated centralized custody, linked every user's wallet directly to on-chain governance, and prepared the ground for what would follow 2 weeks later: the one AFX plus USDT staking model. This wasn't a cosmetic patch. It was the protocol rewriting its own DNA. To understand why analysts now whisper that AFX could multiply from 11 cents toward the $1 mark and beyond, you must see how that one structure changes everything. Traditional DeFi staking relies on single asset exposure. You lock your tokens, receive yield in the same asset, and hope inflation doesn't erode your gain. Aifex flipped the equation. By pairing AFX with USDT on entry, it created a dual collateral pool that stabilizes volatility while amplifying scarcity. Each AFX staked now represents two values: the utility of AFX inside the ecosystem and the dollar liquidity supporting it. Mathematically, this limits speculative minting. The total reward supply, 30 million AFX, cannot expand. Once distributed, it ends. That hard cap means every AFX locked in the one system removes an equal slice of circulating liquidity until redeemed. In a market where supply and perception are identical twins, this becomes the pressure cooker of value. You can already see it on-chain. The active liquidity curve shrinks each week while wallet engagement climbs, a paradox only possible when holders are becoming participants. From an engineering view, the model also makes AI-DeFi self-regulating. The AI engines that monitor staking pools use graph neural networks to measure risk exposure in real time. If capital becomes too concentrated in one cycle, the system adjusts yield rates automatically, balancing distribution without manual intervention. That's the difference between automation and intelligence. The protocol is not simply executing code, it's learning from behavior. Human analysts still oversee the AI through supervised feedback loops, but every decision they approve teaches the system how to respond next time. The result is a living staking economy, dynamic, resilient, and increasingly autonomous. Zoom out to the macro scene. Post-halving Bitcoin dominance is hovering near 56%, but AI-themed tokens have become the secondary index for speculative capital. Fetch.ai, SingularityNet, and Render have already shown that AI narratives can trigger 3-time cycles even without new listings. AFX enters this arena with two advantages: real utility and a finite supply schedule. As liquidity rotates from general AI tokens into DeFi protocols with working revenue models, Aifex becomes a logical target for institutional attention. That's the difference between a token that rides a trend and one that defines it. Yet numbers alone don't move markets. Confidence does. By ending VIP tiers and referral hierarchies, Aifex reset the trust model. Every participant now operates under identical conditions. Transparency and fairness feed community retention, which in turn feeds liquidity consistency. That cycle is already visible in the Telegram and DApp metrics. Daily active users rising while token turnover slows. A classic sign of accumulation. For crypto veterans, that's the quiet phase before price discovery. Consider the mathematics of supply. Roughly 44 million AFX have been burned to date. Assuming a total circulating cap of 100 million and an average stake ratio of 60%, only about 40 million tokens are liquid. At $0.1173 each, that implies a market cap near $4.7 million, minuscule compared to mid-tier AI projects valued above $300 million. If Aifex captures even 1% of the AI-DeFi sector's total value by 2026, the theoretical valuation exceeds $50 million. That translates to a token price around $1.25. It's not hype, it's arithmetic. But markets aren't linear. Once liquidity reaches critical mass, momentum becomes reflexive. The more AFX is staked in one pairs, the less is available for trading. The less available, the more each unit is valued as entry collateral for future pools. That's the supply shock mechanism analysts call recursive scarcity. If that cycle sustains through Q1 2026, $5 isn't fantasy. It's a mathematical extension of network behavior. And if AI-DeFi adoption expands as forecast, a $10 long-term target moves from speculative to visionary plausible. Look back to 2020 to 2021. Decentralized exchanges like Uni and Cake rose hundreds of percent once users believed the supply was locked and yields were transparent. Aifex is recreating that moment in a smarter age. It's one staking pair does what those early tokens never could. It merges a pegged stable unit, USDT, with a variable supply governance token, AFX, balancing volatility while removing inflation. The effect is mathematical scarcity disguised as utility. Every stake pair is an algorithmic promise. one AFX plus one USDT leaves circulation until rewards are exhausted. In aggregate, that's a deflationary mechanism tied directly to user participation. The behavioral response is predictable. When users realize that rewards will end permanently after 30 million AFX are distributed, they race to enter before the faucet closes. That race compresses time. What might have been slow organic growth becomes a liquidity sprint. Staking volumes spike, token flow collapses, and the price curve steepens. Analysts call this the compression phase. It's the same pattern seen before major breakouts in limited reward ecosystems such as Helium and Flux. Overlay global context. After the 2025 Bitcoin halving, miners hold rather than sell, reducing sell pressure across the board. Institutions rotate profits from majors into mid-caps with AI exposure. Funds that missed the first AI wave, those that arrived too late to buy FET or AGIX cheap, look for the next undervalued narrative. AFX, with its fusion of AI autonomy and DeFi mechanics, lands precisely in that search window. Market psychology is simple. Investors chase perceived innovation when risk appetite returns. If capital begins to cluster here, volume alone could reprice AFX toward $1 without speculative mania, just liquidity math. But there's another layer, the AI feedback loop itself. Inside the AFX DApp, the staking optimizer runs reinforcement models that learn from historical liquidity cycles. It observes how quickly users enter and exit pools, then adjusts APR slopes dynamically. That data isn't wasted. It trains the next iteration of the model. Over time, the protocol becomes self-balancing, not only decentralized but adaptive. That's why analysts describe AFX as human-assisted AI. Developers oversee thresholds, but machine logic executes within them. The result is a sustainable reward curve rather than the boom and bust yield farms of old DeFi. For retail participants, this intelligence translates to predictability. When users see daily returns maintain around 1.57% of unreleased principal, as stated in the upgrade notice, they build trust. Stable expectations anchor communities, and anchored communities attract longer-term capital. Institutional desks rarely enter chaotic ecosystems. They enter predictable ones. AFX's algorithmic governance creates that predictability, making AFX a candidate for the next stage of AI-DeFi integration, tokenized liquidity funds. Imagine Q2 2026. If total locked value surpasses $150 million and daily active users double, simple discounted cash flow modeling projects fair value per AFX between $2 and $3. That's the conservative case. In the optimistic curve, where adoption spills beyond the ecosystem into cross-chain networks, $5 becomes the gravitational point. Add speculative momentum from CX listings and market exposure to Western AI funds, and a stretch target near $10 emerges. Not guaranteed, but structurally possible. That's the visionary plausible path. Critically, the system's design removes one of crypto's oldest problems, reflexive dilution. No more print to reward. The 30 million AFX ceiling ensures finite yield. Once rewards end, the market transitions into pure utility, value driven by AI-DeFi services and transaction volume. That's when price detaches from speculation and attaches to productivity. Projects that reach that stage become infrastructures, not tokens. Ethereum did it with gas. AFX aims to do it with autonomous liquidity. Social metrics reinforce this direction. Telegram membership climbed 22% since the protocol upgrade, yet spam reports fell, a rare combination showing organic retention. Average hold time per wallet has extended from 9 to 27 days according to DApp Analytics. These micro-indicators precede macro trends. They're the whispers before the charts shout. Veterans notice. Whales are splitting stakes across multiple wallets to test release timing. An early signal of structured accumulation rather than casual speculation. Macroeconomists watching the AI sector note a clear convergence. As artificial intelligence models decentralize compute power, they require decentralized liquidity. AFX sits at that intersection, providing on-chain capital to off-chain AI processes. That synergy could make AFX a utility layer for algorithmic markets themselves. In that scenario, token demand becomes endogenous. AI agents stake AFX to access compute credits or data streams. That feedback loop turns AFX into an economic primitive of the AI web. If that narrative gains traction, even a $10 valuation may look conservative by 2027. As the camera pans across dashboards glowing with blue-gold graphics, the narrator's tone steadies. This isn't hype. It's engineering meeting timing. AFX's transition from centralized oversight to AI-DeFi autonomy represents the same philosophical pivot that defined the early internet, from servers to networks, from companies to protocols. What we're seeing now is finance learning that lesson again. The scene fades to on-chain data streams, staking volume graphs climbing, burn addresses flickering. Voiceover. Every epoch in crypto has its inflection point. For AFX, it began when the team decided to let go of control. The idea of autonomy isn't just marketing, it's measurable. Smart contract audits show zero admin keys with override authority. Governance updates require multi-sig consensus. The protocol now lives by its code, and code, once trusted, compounds. Once rewards end, Staking transitions to liquidity provision for AI agents that trade or optimize portfolios on behalf of users. Each agent requires collateral to operate. AFX becomes that collateral. AI modules submit microtransactions on-chain, paying AFX as execution gas. Because those agents recycle profits into the same ecosystem, a circular economy forms. Supply that was once inflationary becomes self-consuming. This design mimics proof-of-stake security, yet applies it to decentralized artificial intelligence workloads, a category analysts call proof of intelligence utility. It's the logical next step after proof of liquidity. The implication is profound. If network usage expands linearly with AI automation, AFX demand scales exponentially relative to available float. In a moderate growth scenario, transaction fees alone could burn 1 to 2 million AFX annually, permanently tightening supply. A deflationary token underpinning an inflationary service market is the textbook recipe for long-term price expansion. At that stage, the $1 to $5 range becomes baseline valuation, not peak speculation. History shows that crypto assets anchored in tangible revenue models outperform during liquidity rotations. When meme capital exits, fundamental capital follows transparency. Aifex's public DApp dashboards publish every reward, burn, and release schedule in real time, giving analysts the data integrity that centralized exchanges rarely match. That transparency converts traders into stakeholders, a social dynamic measurable through community retention ratios now exceeding 70%. If that figure rises to 80%, statistical modeling projects a doubling of price elasticity, meaning every 1% increase in demand could translate into a 2% price shift. That is the essence of reflexivity. Perception creates performance. Zooming out again, the 2025 to 2026 macro picture favors intelligent finance assets. After the halving, global liquidity hunts yield. AI infrastructure tokens such as FET, RNDR, and NEAR have proven that machine learning narratives attract both retail and institutional flows. However, those projects remain compute-side plays. Aifex sits on the finance side, the capital layer enabling AI agents to trade, learn, and evolve autonomously. Correlation analysis with Bloomberg's AI crypto index suggests that for every 10% increase in the index, DeFi AI hybrids capture 15 to 20% relative upside. If that ratio persists and AFX maintains current beta exposure, a $10 token valuation under full network maturity aligns perfectly with the model. While the company avoids naming specific exchanges, the scheduled CX integrations hinted in the September circular imply multi-venue deployment. For context, a dual listing on 2 Tier 1 exchanges historically triples daily volume within 72 hours for tokens under $10 million cap. Liquidity depth attracts arbitrage desks. Arbitrage desks require inventory. Inventory means purchases. That mechanical demand alone can lift a 11-cent asset to 30 cents without speculative hype. Add the staking lockup effect, and the slope steepens. Every technological revolution carries a human story. Aifex's journey from a small centralized platform to a self-governing AI-DeFi network mirrors crypto's own maturation. In community channels, early users describe watching their dashboards evolve from static yield pages into living analytics portals. They're no longer investors. They're participants in a decentralized experiment teaching machines to manage capital ethically. That emotional identification matters. Conviction lengthens holding periods, reducing volatility. Behind every chart candle are people who believe autonomy is worth waiting for. An expert analysis must also weigh risk. If AI-DeFi adoption stalls or regulatory scrutiny constrains algorithmic trading, velocity could slow. Liquidity lockups magnify both gains and losses. Yet Aifex's transparency and capped emissions mitigate existential threats. It isn't promising infinite yield, it's promising finite opportunity. That framing attracts sophisticated capital instead of speculative churn. As the journalist voiceover reminds, the real strength of a protocol is measured not by how fast it rises, but by how it behaves when the noise fades. Projecting beyond 2027, scenario models branch into two arcs. In the conservative arc, Aifex stabilizes as a mid-cap infrastructure token trading between $2 and $3, with passive yields replaced by service fees from AI agents. In the visionary arc, the platform becomes an autonomous liquidity grid where every AI trader, DAO, and synthetic asset protocol uses AFX as standardized collateral. That environment could support valuations north of $10 per token with network effects similar to early Ethereum gas economics. Neither outcome requires hype. They require execution, something the current roadmap demonstrates quarterly.